Welcome to this brand new explainer on the Gap Advisors Ind AS Clinic YouTube channel. Today, we're taking a really complex real-world accounting scenario and breaking it down into simple, actionable steps. You know, if you've ever tangled with the intricacies of government grants and import duties, you know exactly how fast things can get complicated. So let's jump right in.
But real quick, before we dive into the technical details, I want to point out that today's issue and its response come directly from the massive issue repository over at gapadvisors.com. It is an amazing resource hosting over 4,500 issues, complete with detailed responses on Ind AS and Indian GAAP. And the best part, anyone can register for free. You can submit your own issues on Ind AS or Indian GAAP, and you'll get a detailed response delivered straight to the inbox of your registered email. It's honestly an essential tool, especially for auditors who need to meticulously document exactly how they tackled a specific Ind AS application. In fact, this specific explainer brings to life an issue that was featured in the 225th edition of the Gap Advisors Task Weekly newsletter. It's authored by CA Manish C. Iyer, director at Gap Advisors, and published over on LinkedIn. To date, a whopping 232 editions of this weekly newsletter have been published. So if you're on LinkedIn, do yourself a favor and subscribe to it for free.
Now, just a quick heads up on our standard disclaimer. The views expressed here are simply the personal views of the author and are not binding on the audience. We always request that you seek the help of an expert before taking any action or, refraining from any action based on the views we're discussing today.
Okay, here's our agenda for today. We're going to look at the import duty dilemma, decode Ind AS 20, map out the accounting solution, and wrap up with presentation and disclosure. Section 1. The import duty dilemma. Let's set the scene for our accounting mystery. To make sure we're all on the same page, let's lay down a few ground rules for this explainer. We're going to assume both the functional currency and the presentation currency for our company is the Indian rupee. Also, our financial reporting period runs strictly from the 1st of April to the 31st of March.
Picture this scenario. In year 0, our company imports some raw materials completely duty-free. Sounds great, right? But there's a massive catch. The company is immediately put on a strict 6-year clock to discharge commensurate export obligations. If they miss this hard deadline by year 6, they have to surrender the benefit entirely and pay back that duty. Now, the company is pretty confident it can hit these targets based on current export orders and past experience, but the pressure is definitely on.
And that temporal pressure leads us to the most critical question of this whole explainer. Does saving on import duty, under these incredibly strict conditions, actually qualify as a government grant?
Section 2, Decoding Ind AS 20. Let's look at what the standard actually says about government assistance.
To get our answer, we have to go straight to the framework. Paragraph 3 of Ind AS 20 clearly defines government grants as assistance by the government in the form of resource transfers to an entity in return for past or future compliance with specific conditions relating to their operating activities. Because our company is saving on import duty in exchange for future compliance, specifically those export obligations over the next 6 years, this absolutely fits the bill. So yes, that import duty saved is definitely a government grant.
Okay. So we know it's a grant, but what kind of grant are we dealing with? The standard distinguishes between two main buckets. First, we have grants related to assets, where the primary rule is that the entity has to purchase, construct, or acquire long-term assets. Second, we have grants related to income, which are basically just defined as any government grant other than those related to assets.
Let's apply that logic here. In our case, the company has two primary conditions: import the goods and then export the goods. The grant becomes repayable if that export obligation isn't met. So are the imported items long-term assets? No, they're raw materials. And because they are raw materials, this cannot be a grant related to assets. Therefore, by simple process of elimination, this specific grant is definitively related to income.
Section 3, the accounting solution. Let's map out the exact journal entries for this.
For the initial recognition on day 1, you're going to debit your inventory account and credit the deferred government grant account. This perfectly captures the asset while setting up the deferred liability framework we need to track that grant benefit. But obviously, the story doesn't end on day 1. As the company discharges those export obligations year by year, you'll need to recognize it. You'll do this by debiting the deferred government grant account and crediting income from government grant. The absolute key takeaway here is that this is recognized in profit or loss in the exact proportion of the export obligations discharged that year. It's a progressive realization tied right to the company's performance.
Section 4. Presentation and disclosure. let's finalize those financial statements.
When you're building your final reports, you have to present the duty saving as a deferred government grant right on the balance sheet. But throwing numbers on a page isn't enough. For total transparency, you absolutely must disclose in your notes the precise relationship between satisfying that export obligation and the corresponding movement of the deferred government grant.
Well, that wraps up the technical side for today. Thank you so much for your time. Please hit that like button, drop a comment below with your thoughts, and if you haven't already, make sure to subscribe to the Gap Advisors Ind AS Clinic YouTube channel. Also, I highly request that you share this explainer with your contacts, your colleagues, and your audit and finance teams. It really helps us spread the knowledge of Indian accounting standards.
Now, if you want a true deep dive into the nuances of this specific issue, you've got to check out the Gap Advisors Ind AS Clinic podcast. You can connect to it right now on Spotify, Amazon, or YouTube. It's an incredible way to keep building your expertise on the go.
And I'll leave you with this one final provocative thought. We know the rules when everything goes perfectly. But what would happen to your current profit and loss statement if, halfway through that 6-year timeline, a sudden supply chain shock made fulfilling those export obligations literally impossible? Think about how drastically your financials would be impacted when you're suddenly forced to surrender that benefit. Something to chew on. Keep learning, and I'll see you in the next explainer.